Want to know how professional investors analyze stocks before buying? In this video, I'll show you step by step how to evaluate a stock like a pro and make smart investment decisions. Let's dive in. Before looking at numbers, understand what the company does and how it makes money. What industry is it in? Tech, healthcare, finance, etc. Who are its competitors? Does it have a strong competitive advantage, brand, patents, market dominance? Example: Apple dominates the smartphone market with loyal customers and strong branding. Tesla leads in EV innovation, with a first-mover advantage in the electric car market. 1. Revenue and earnings growth. Look at the company's revenue, sales, and net income, profit, over the last 5 years. Consistent growth means strong business model. Declining sales or inconsistent profits. Where to check? Yahoo Finance, Google Finance, company reports. 2. Price to earnings, P/E, ratio. The P/E ratio compares the stock price to earnings. A lower P/E than competitors means undervalued stock. A higher P/E. It may be overpriced, unless the company is growing fast. Example: Tesla's P/E is usually high due to future growth expectations. Coca-Cola's P/E is lower, reflecting slow but stable growth. 3. Debt levels, debt-to-equity ratio. A high debt ratio means the company relies on borrowing, which can be risky. A low debt ratio means the company has strong financial stability. Ideal range, below 1.5 for most industries. Debt higher than competitors or increasing fast. A moat is what makes a company defendable against competitors. Types of moats. Strong brand, Apple, Nike. Patents and tech, Tesla, Nvidia. Cost advantage, Walmart, Amazon. The wider the moat, the safer the long-term investment. If CEOs and hedge funds are buying shares, they believe the stock is undervalued. If they're selling in large amounts, be cautious. Where to check? Yahoo Finance for insider transactions. Is the industry growing? Is the company launching new products or expanding globally? Does it have an innovative edge? Example: Amazon grew from books to global e-commerce and cloud computing. Nvidia went from gaming GPUs to AI and self-driving technology. Strong revenue and profit growth. Reasonable P/E ratio. Low or manageable debt. Wide economic moat. Insider and institutional confidence. Future growth potential. Want to start investing? Check the links in the description. How to analyze a stock like a pro. Understand the business and its competitors. Check financial metrics, revenue, P/E ratio, debt. Look for a strong economic moat. Follow insider and institutional buying trends. Analyze future growth potential. Master these steps, and you'll never invest blindly again. If this video helped you, give it a thumbs up and subscribe for more investing tips.